The IFA Show. The stories behind the financial advice headlines with the team from IFA.
Hello and welcome to the IFA Show. I'm your host, Keith Ford, and I'm joined today by the CEO of the CSLR, David Berry. Welcome to the show, David.
Thanks, Keith. Looking forward to the conversation.
Great to have you in. I don't think our audience needs me to clarify, but CSLR, Compensation Scheme of Last Resort, hasn't been around terribly long. It was April last year it kicked off.
2nd of April.
On the 2nd of April, which I did kind of joke previously that was similarly to Donald Trump with his Liberation Day, specifically skipping April 1st. I don't know. Was that intentional, do you think? Do you know if that was intentional on behalf of the government?
I'm pretty sure 1st of April was Easter. It was Easter Monday. So
gotten away
can
with
avoid
it
that
there.
one. Yeah.
All right, gotten away with it. Not the case this year for Donald Trump with Liberation Day. So he just, has to have decided that. Off the bat, so that makes it 16 months that the CSLR has been in operation, that it's actually been moving. Over that 16 months, what have you seen? What have you found from the CSLR so far and how it's been operating?
I think there's a couple of things which we've observed. The first is that those doing the wrong thing have a disproportionately large amount of noise compared to those doing the right. So we see that, and we recognise that we're seeing the worst of circumstances, and the stories which we are dealing with and people's livelihoods, if we were to share them with any advisor that is doing the right thing, they would go, that's just not right. So it's unfortunate that the few that are doing it wrong are having such a big impact on those that are trying to do the right thing. And we're starting to see that now with Shield and First Guardian. I think it would be surprising if most advisors hadn't had a number of their clients come to them and say, should I be worried? Just the fact that they're asking would suggest that the advice profession is it's under siege, and it needs strengthening.
Yeah, you mentioned there Shield, First Guardian. Over the course of the CSLR's operation so far, the majority of the focus had been Dixon Advisory right at the start, then kind of flowed through to United Global Capital following that. Now we've got these other large financial firm failures, I think is probably what we're calling them. I think that's what it's in the actuarial report for the CSLR. That's what they're called, right? Which I think is probably a fairly apt descriptor. When you're looking at it from the perspective of what you've actually been working through so far, because obviously Shield, First Guardian, they're down the track for the most part. What you've worked through so far with Dixon, with UGC now as well, what have you found in terms of the commonalities between those two, perhaps, or where the way that the advice, which is what has come through to the CSLR and what we're talking about, where that advice has failed, any commonalities there, I guess?
Yeah, certainly. So what we're saying, speaking to Shail Singh, the Ombudsman at AFCA, he can give you a lot greater depth and breadth. What we see, that narrow part which is unpaid and eligible for compensation, there are some common themes. So the first is the use of self-managed super funds.
Right.
Now, there's no problem with having self-managed super funds, and I'll be quite happy to advocate for them, but they need to be for the right people for the right reason. But the combination of a self-managed super fund and encouraging people to take funds out of their industry fund, and for the advisor to then advise them to invest all of their funds in a single asset or product that has a different risk profile than what they're actually wanting. We're seeing, that's just what we're seeing. And whether it was Dixon or UGC or even some of the other smaller firms which we've dealt with, the combination of self-managed super fund, integrated product that's offered, vertically integrated products that are offered, and property, just those three combinations, there needs to be a heightened level of advice and expectation setting with clients to make sure they understand exactly what's going on.
You did mention property there, which does seem to be a bit of a theme, particularly with the large fund failures, that they are heavily invested in, in property developments and things along those lines. You look at some of the assets, quote unquote. Not sure they count as assets necessarily, but held in, this Shield and First Guardian Master Fund and things like that. You've got, like a hotel in Italy. You've got resort developments, things along those lines. Not what you would necessarily usually think I'm going to invest my super in. Doesn't really feel like... In some cases, it feels as though they're not quite being disclosed exactly what the holdings are to the clients and things like that. They're being made fully aware. But is there something particular about property development that is just attractive to the people that are putting these funds together for some reason?
Look, I suspect there is. They're either making lots of money from it, and they're giving conflicted advice. So the advice which is being given is not in the interest of the person who's investing, it's in the interest of the person who's going to use the funds. I think it's not just the conflicted advice, it's also just the inappropriate matching of the risk profile. So there are different risk profiles for different sorts of property, and your mum and dad investor are relying on an advisor to help them understand those different risk profiles. And navigating financial products is not for the faint-hearted. It requires somebody who knows what they're doing, and that's why we need financial advisors who understand that and can explain it to people.
Yeah, and doing the job correctly, I suppose, as well. On the SMSF side, so that was a fairly prominent feature of the Dixon and the UGC. It doesn't appear as though it's the same level with the follow-up ones, the Shield and First Guardian. A lot of those have been put into, APRA-regulated super funds, retail funds that have been have their platforms that have these as investment options on there. So that's probably going to be a shift you'll see as those filter through. I know obviously it's not all of them are going that route. You mentioned United Global Capital. It also, alongside putting clients into its own fund, the Global Capital Property Fund, there's property again, which, as we've covered previously, is not actually a fund but a company. It also, in some instances, put them into the First Guardian Master Fund as well, but in that instance through the SMSF. So at this stage, probably not a lot of these large fund failures that have been tied to APRA-regulated funds at this point, right? Mm-hmm. So is there going to be much of a difference in the way that it's dealt with from, well, I suppose not from your end. That's probably a question, as you mentioned, for AFCA. But have you started to see any of that flow through, or is it very much at this point still confined predominantly to the SMSFs and being clients being advised to roll over into those?
Well, I guess separate to that, I mean, SMSFs are a great investment vehicle if you fit the right criteria and you've got the right objectives. I look at how we treat these, that we have found with SMSFs, people have realised this isn't right for me afterwards, and we have seen where they've closed their SMSF just because the accounting fees and auditing fees and all of the administrative upkeep they need to go through. When we get an AFCA determination to that super fund and that super fund no longer exists, it's hard work, and it's hard work in being able to get the funds to the actual beneficiaries. It takes time, takes effort, it takes a lot of energy from the claimants because they have to substantiate trust deeds, the winding up provisions in the trust deeds, and we have to certify that they are the correct beneficiaries. So it takes time. Right. And we're working with ASIC to try and to make that process smoother, but there's specific legislation around unclaimed monies, and if the company no longer exists, it should be going to them for them to work that out.
Right. So, I mean, in the ASIC's corporate plan, which they released yesterday, actually, we're recording ahead of the podcast going out, probably by about a week. So for anyone Just like, no, that came out last week. We're recording early. It came out yesterday. They have, unclaimed money is a portion of the corporate plan that they've got in there. They're talking about that. But that does kind of raise an interesting question where there has been some talk around, why is the cost to run the CSLR as high as it is in the report and all of that kind of stuff? Why is so much funding? A lot of that, as you told me previously, is, the setup costs for something like this is not going to be the same as the cost to run. Something along these lines where you have to put in a lot of administrative work and man hours to actually be able to even pay a claimant, someone who is getting compensation. That's got to jack up the prices a little bit for the CSLR, and then ultimately the subsectors that cover the CSLR are paying for that, right?
Yes, yeah, ultimately. The challenge with starting an organisation from scratch is everything is starting from scratch. And we've invested heavily upfront to try and make that as efficient as possible, not just for the last 12 months, but for the next 12 months and the 12 months after that. That said, we've got a higher propensity to want to make sure we do it right rather than doing it fast. So with a greater focus on quality, it is a little more expensive than if we were running quickly, but we want to make sure we're paying the right amount to the right person.
Yeah. Slightly different tack in that it's not around the, use of SMSFs or anything like that, but where there's been a bit of a shift between the initial claims that came through on the CSLR that are related to Dixon Advisory, and then the following claims, keeping it to the large failures, so the United Global Capital. In Dixon Advisory, there was, as you had kind of thrown the figure out on a webcast we did last year about the CSLR, that about 80% of the cases involved a but-for in the determination, whereas UGC, a lot of capital losses. It's not so much the but-for at this stage. Yeah. And having, we looked at the few UGC ones that are First Guardian related that are publicly available. There's only, at this stage, about 3. Again, large capital losses. There's some UGC ones that are almost $1 million of actual losses, and then scaled down to the AFCA limit of $631,500
yep.
As the maximum they can award. And so that's a lot of money. Obviously, they're not going to get all of it through the CSLR with that $150,000 cap, but has that been a real structural shift in what you've seen coming through to the CSLR, that there is just that but-for question is not the same kind of an issue with these later ones as it was with Dixon? No,
certainly the but-for, we've looked at it across all the 4 subsectors which we support, and really securities dealing has the potential, but we don't see many claims that fit the securities dealing subsector. What we do see though in the advice space is that it will feature more prominently, but Dixon is certainly overweight. There's the but-for features pretty much in every single Dixon claim that we see.
Yeah, and so even in the the UGCs, they do have a but-for component in the determinations, what AFCA's put out, but they're so far above, in many cases, so far above the $150,000 cap that in practice it doesn't really have an effect.
And as well, the timing when the advice was given and to when the claim is, or the complaint is lodged is a lot shorter. A lot of the Dixon, there's advice going back to 2014 and even before. So a poor advice given in 2014 can have a substantial impact on your but-for component. And with but-for, it still has the potential. We don't know what Shield and First Guardian will reveal. We've, as mentioned previously, we've only seen a couple, and it's hard for us to know what normal will look like for those two. But there's every chance that some of that advice could have been given a long time ago, and but-for could feature in some of those claims.
Somewhat relatedly to this, and I'm not sure how much it will kind of come into play with United Global Capital. I'm not sure what the potential for any distributions to investors that have been impacted, what the liquidators are able to get out of UGC and the fund/company, the GCPF. But with the down the track, Shield, First Guardian, there's some talk that for Shield could be as high as around 60 cents on the dollar, potentially being able to return to those investors. My question to you essentially is, how does that impact on the CSLR payments? So obviously, if there is money being returned to the client, then that would come off their amount. How is that dealt with from the CSLR side?
No, that's a really good question. So keeping in mind Shield and First Guardian are products and they don't fall under the scope.
So Keystone
Yep.
as the responsible entity for Shield, Falcon Capital as the responsible entity for First Guardian, but of course the actual claims will be against advice firms in terms of, well, potentially also super fund trustees, but that they don't fall under the CSLR purview. That's, again, a question for Shale.
Yep.
Asking about super fund trustees and the potential there. But it will be against any advice firms and advice licensees that go into liquidation. Some have already happened, some are maybe happening. But so with that in mind, how would that work, do you, in terms of the effect on the CSLR payments?
So our subrogation rights only give us access to the firm that the claim is against. So it doesn't give us direct access to Shield or First Guardian assets. So it will be against the advice firms. If the advice firms can't pay or they're in liquidation and unable to pay because of their company status, then we can issue compensation up to $150,000. Now, we've had conversations with AFCA to just say, and they're supportive of this, that, hold on a second, there are assets here and there is a chance to recover. And they recognise that because we don't have a subrogation right, if you have a look at their determinations, and particularly with UGC, where you can see that in a little more detail, it will be the claim against UGC less any funds that may be forthcoming from GCPF. So they've linked any proceeds from the asset that can then offset what we would pay in compensation. So we can take them into account thanks to the wording of the determination, and we do.
I can read the wording from one of them if you like. My laptop has a disgusting amount of tabs in the browser window. It's just awful. So I've just got them up. The specific wording in this one, for instance, less any amounts or distributions received from the financial firm and or FG, in this instance, First Guardian, as part of the liquidation process. So that's the wording in this specific AFCA decision. The others will likely be pretty close to that. So continue.
Yeah, so it means we can pay the compensation, but we've also got access to recovery of funds through that liquidation process. And so we work with the liquidators to make sure that they understand they will need to pay us some of that money. Yeah,
so to look at this one, for instance, this specific case, the determination was for $383,493.27. That was not including $5,000 for the cost of winding up the SMSF. So then goes up to $388. Say they got, that is including the but-for portion. Again, way above the $150, not really an issue at this stage. But say they got, 60 cents on the dollar of their investment that was lost. Again, this is First Guardian, not Shield, and the likelihood is much lower for First Guardian. So maybe I'll just go with 50%, and that's probably generous. If they're, the actual losses are about $300,000 in this one, 50%, $150,000, that would come down, but it would still be above the $150,000 limit. So in that instance, this is, a lot of hypotheticals and ifs and buts and whatnot. In an instance like that, it would still be getting the $150,000 from the CSLR, correct?
Yeah. And it was one of the recommendations we've made in the post-implementation review of the scheme, where the way that distribution works or the recoveries that might come through from any liquidator, say they've made a loss of $180,000, regardless of but-for or whatever. Yeah. If that firm in its wind-up was to pay a dividend of $40,000, that $40,000 comes off the top. So $180 down to $140. So the compensation payment would be 140.
Yeah.
One of the things we've advocated for is, as a scheme of last resort, that 40 grand should come off first of the 150. So instead of 140, it would be actually 110, being 150 minus the 40,000 already paid. We recognise the sustainability of the scheme is really important. When I first took on this role, the expectation was, look, you've just got to get through Dixon, and then after that, it's 100 claims a year. That's not come to fruition, and it looks like we're going to be busy for quite some time. So thinking needs to be adjusted so that the scheme can support those who are the victims of poor conduct from people within the industry that we would be quite happy to see leave. So we want to make sure, with all of the recommendations we've made, that the right outcome is that the scheme is still there, it's still protecting people, but that it's also representative of that last resort.
Yeah. We're going to take a quick break. I've got much more on both what I asked you and then the submission to the review as well. But we'll come back to that after the break. We'll have more from David Berry shortly. All right, we are back now with more from David Berry from the CSLR. As we went to the break, we were talking, David, around the way that any distributions from financial firms that have failed get paid to clients and then impact the amount that they can get from the CSLR. If they're, as things stand, if they're above that 150,000, until it gets under that 150,000, they still get the 150,000. So even if their determination brings them down to $150,001 after the distribution, they still get the 150. So you mentioned in the submission that you made to the post-implementation review that, you would look at changing that. You would recommend changing it so that it comes off the first amount, not the total AFCA determination. Given the rules as they stand, though, is there a time frame on that money coming back to clients from distributions from the fund? And I guess this would also work going forward in the instance that it reduces the actual cap amount as well. What's the time frame on paying out the claims to, of compensation, given that it could be years until they actually get those distributions from the fund? So, even the most optimistic view for something like Shield would be, you might get 60 cents on the dollar. In a situation like this, that's actually really good. First one might take, you might get that a year from now. You might not be done until 5 years. If you're paying compensation to these people and it could potentially bring them below that 150 cap once they've gotten the distribution, do you claw that money back? Like, how's that work? Does it affect when you're able to pay them?
So we either use our subrogation rights or through a deed of agreement, and it effectively means that when we pay the money up front, they're assigning all rights to all distribution from any of these, from the liquidator to come to us.
Right.
We'll deduct what we are entitled to, and then we'll pass the remainder, if there is remainder, on to them.
Right. So if it would bring them under the CSLR payment cap, you would keep whatever is any past that, and then the rest would go to them.
That's right. Yes.
Right. Okay. That does make sense. Because I was thinking, if you've paid them and then you have to try and get it back from them, that just feels a bit cruel for someone who's
Well, and we certainly recognise that the scheme was set up to help the victims. Yeah. So, looking at things that are going to delay payments to them, most of our clients or claimants we're paying claims to, they're in the later stages of their financial earnings, and their ability to recover the funds is almost gone, and there's very little they can do to recover the losses which they've made, and that's going to affect their mental health, their physical health, their personal circumstances. We've seen people that have had to sell their homes, move into remote locations because that's the only place where they can actually afford. So we recognise the need for providing clarity as quickly as we can for the victims, and that will always be our first priority, given that that's what the aim of the compensation scheme of last resort is to do.
Yeah, and I guess in many instances it'll have been a little bit of a little while from when the money was actually lost to when they're getting it even even the ability to lodge with the CSLR. So they've already probably gone through a period of time, and then you might be stuck longer.
The anxiety levels of the people that we're dealing with are at extreme levels. So if you can imagine you're 55 to 60, you're thinking about retirement, you've spoken to somebody who said, I can get you a better return, and these are smart people, but when it comes to navigating financial products, that they're just looking for an expert that can tell them, okay, yes, this is all right, this is what you can do. Then a couple of years later, they get they read something in the paper or they get a notice and it says, oh, hold on a second, I've just lost all of my super and I've been working the last 40 years to try and build this up. What am I going to do? I can't retire. I'm going to have to work till I'm 75, 80. How am I going to, continue to maintain a lifestyle that, I was looking forward to, and then all of a sudden I can't. Their stories are real, and the impact on these people is significant.
It certainly would be. We've heard, some instances where people have, really, really taken drastic action, and it's obviously not something that is good to hear about, and it just kind of drives home what the impact of these things and that there is that human cost, not just dollar amounts, that does translate to a real human impact, which is obviously awful. And I guess that is the whole idea of having that last resort scheme. Yes, obviously where a lot of advisors in particular and advice associations and things like that have kind of got a problem, is that it doesn't seem as though it's being used as a last resort. From the perspective of the CSLR, do you think as things stand, it is being used as a last resort? Or
I do. I think most people just don't want to pay for it. And so they'll look for every argument that they can to say why they shouldn't. Keep in mind, last resort for us means that the claimant has nowhere else to go. There's just nothing else available. They've tried to resolve it with the firm. They've tried to resolve it with the ombudsman, and they haven't been able to. The firm's gone into administration or liquidation. Their bargaining power with any liquidator or administrator is negligible, mainly because they may not even recognise the claim of AFCA, depending on when AFCA's determination was made. There really isn't anywhere else for them to go. So when they say, the compensation scheme of last resort's not the last resort, I'd challenge them on that. Go and ask the victims. You ask them what they've gone through for the last 2, 3, and in the case of Dixon, regardless of whether they feel they're eligible or not, these people have had significant concerns for a long period of time, and you ask them if they feel they're at the last resort when they come to us.
Yeah, which, I'm sure for many of them it absolutely, well, most or all perhaps. I think in some ways the discontent with the way that the scheme is being utilized is much more around there needs to be a way to get the money from the people who've actually done the wrong thing.
Absolutely.
I think that's probably what's fueling the anger and from people who are having to pay for other people's misdeeds, is that why is more not being done, whether it be the regulator, whether it be the government changing legislation to kind of put a stop to the phoenixing, not really phoenixing stuff and things along those lines.
A great example of this is, ASIC has just taken equity trustees to court, to sue them. If they're successful, I haven't seen the evidence. I'm assuming they've got enough evidence to lodge a case here. Assuming there's
send you the statement of claim if you like.
No, I tried to read it. If they're successful and they receive a substantial money in fines or in compensation, it's not the victims that are going to get that money. It's going to go to consolidated revenue. It's going to it'll go into the government coffers, which that's the way the legislative process is set out, and that's we deal with rules and regulations that are the Constitution and is the legislation that we adhere to. That's just what's going to happen. That for me doesn't sit right, and I'm sure it doesn't sit right with a lot of people.
I think you absolutely bang on that. Certainly the IFA show's audience is not going to be a fan if they do recover compensation or recover some money from equity trustees through a lawsuit if they do get a fine, something like that, and it goes to consolidated revenue, which, as you say, is probably what will happen. I don't think our audience will be happy with that.
And look, people are pretty easy to point the finger at. Like someone's, ASIC should have done this, AFCA should have done this, CSLR should have done this, or the minister should have done this. I'm a big advocate for what I've seen of ASIC in the last 12 months. The amount of effort that they're putting into protecting assets. So we saw them freezing assets from some of these, and also just the enforcement activity that they're doing, the bannings. There's been a serious step up here where they're stepping into this. They're not stepping away from it. So as much as people might say, well, they should have done it sooner, it's always easy to talk about what could have been. What I'm happy with is what I'm seeing right now is that they are taking massive steps forward to protect the vulnerable consumers, and in turn it will protect the profession and the industry.
Yeah, I think there has been some very reasonable criticism of the way that ASIC had handled the Dixon Advisory one, for instance, that not a single advisor banned out of Dixon Advisory, and yet all of the blame in terms of compensation has gone to the advice sector, and that not really jiving. Questions around the investment committee and its direction to the advisors and things along those lines, and yet no advisors banned out of that. Certainly not the case with the Shield. So far, just Shield. No First Guardian related bannings. I suppose the next gen would count as that. So the way it's acting here in terms of the bannings, the cancellations of licenses, and then also the lawsuit that you mentioned against equity trustees, that does feel like a bit of a step up in terms of the enforcement action against people who have, it's determined have done the wrong thing. So I mean that's probably a positive for.
Yeah, and look, there's still plenty more to do. I'm not necessarily referring to ASIC. I think the responsibility on, I don't envy the minister. They've got a tough job. I mean, that portfolio is huge, and this is just one of many things which Minister Molino is dealing with. But when I look at the phoenixing issue, and particularly where you can have a parent company that can purchase something, shed that subsidiary of all of its assets and revenue, and then wind it up because it can't pay any compensation or determination from AFCA. There have been those in the industry that have said, well, it's all legal, so it's okay. No, it's not okay. Yes, it might be legal, but if you think that's okay, then I suggest you redo your ethics and taking a good look at how you break down problems. We shouldn't be looking at what's the absolute minimum we should be doing. We should be taking accountability. And I think the inquiry that the FAAA had been pushing with the Senate, looking at failed firms, there was a real opportunity there to have a look at, well, what is the accountability for responsible members or responsible managers of subsidiaries? If you're going to purchase something, you've got to stick through it. You've do your due diligence. If you haven't done your due diligence, that's on you.
No, absolutely. And I mean, there's was also an ASIC case against the Dixon Advisory director over exactly what we're talking about. They did lose that case, unfortunately, for ASIC. So at this stage, not a great precedent for taking action against any of that. It is, however, an area that in some of the, not only the Senate inquiry that you mentioned, which of course, change of parliament, it no longer exists, but the expectation is that it will be reformed. Alongside the submissions to the post-implementation review for the CSLR is around trying to fix that issue, trying to come up with a way that you are able to still go after that parent company and not just, sorry, nothing we can do, hands are tied. Mentioned your submission to the post-implementation review. Any suggestions from the CSLR on how this might be done?
Look, no.
No. It's a hard problem. This is the issue, right?
It is a hard problem, but the debate needs to be had to work out what the options are. There's going to be no options that I don't see a solution here where everybody's going to go, yeah, that's awesome. There's going to be people who are upset with any of the options that are put up. So it's what's in the greater good. And that's the challenge of being in government. It's to what's for the better, what's for the greater good of the Australian community.
Yeah.
And certainly interactions with Minister Molino's office, he wants to do the right thing, and he's being very consultative about it.
Yeah. On the topic of the submission to the review, any kind of, it's not public yet, but any kind of headline recommendations from the CSLR to do with that post-implementation review that, where you're seeing the issues with how the scheme is set up at the moment, or where you would look for improvements?
Yeah, sure. So we will be releasing it soon. We haven't yet set a date on when that was through. We were hoping that that Treasury would have provided the review to the Minister's office, and that the Minister would be wanting to release it. That said, there's no requirement for Treasury or the Minister to release it. That wasn't part of the terms of reference. Equally, Treasury aren't going to make recommendations. Their request was to make findings. So it just means there's going to be more work that will follow. And I think the consultation paper on the special levy will help build the information that sits behind this to try and work through what's the right way to proceed. When it comes to our post-implementation review, we did find a number of things which we thought needed addressing. When we first started, we tried to work through what's the priorities for us here, and number one for us was making sure the scheme would remain sustainable. There are people that need this support, and we want to make sure that we're there for them in the years and decades to come. The next is that we needed to provide support to those who are the victims of financial misconduct, and making sure that they are appropriately looked after and supported through a very traumatic process. And we're dealing with them at the end of that traumatic process. The next is the challenges and shortcomings of the current funding process. And I'm happy to go through that in a little more detail. And the next is just on what can we do to address industry practices that will help for the future. When it came to ensuring the sustainability of the scheme, we asked our actuaries to pull together what does normal look like? What should we be expecting? So in our report, you'll see there's a table there that just outlines firm failure by magnitude. So it goes from BAU, material, significant, major, and massive. Each then has its the impact, whether it's the number of complaints that are lodged with AFCA, or if it's the amount of compensation that's going to be paid. So there's those two criteria. Yeah. So a BAU, we're expecting it to have up to 9 complaints with AFCA, or compensation of up to $1.25 million that's going to be paid. Normal is we would expect to see 4 of those a year.
Right.
In our first 18 months, we've seen 8.
Not great.
No. When you look at the massive, so the massive was where there's more than 400 complaints that are lodged, or there's more than $50 million in compensation that's going to need to be paid. Well, that's a 1 in 20 year event. Dixon, okay, well, that was the first 20 years. UGC has just come. We're now dealing with Bright, which we don't know the full extent of how that's going to impact.
Thing, isn't it?
Yeah, you've got all the fallout from Shield and First Guardian. So initially they were called black swan events. Well, I think we're dealing with white swans now, because there's
at this point, yeah.
Yeah, so we're dealing with quite a few of these. Now, this was our first go at this. It was our benchmark of what we thought was not what normal was supposed to look like. We're working with our actuaries to do this updated every year, so that we can set our own expectations of, well, what does the funding need to look like in this year, in the following year, and in the subsequent years after that. It's fair to say we're seeing far more firm failures than we were expecting to see. And the majority, well, actually all of these, were based on conduct before the CSLR even existed. And they're going to have a long tail. They're going to be around for a long time. So with that as our premise, we then said, well, how do we make sure the scheme is sustainable? And look, I'm happy to go through all of my notes.
Happy for that.
I think with the compensation for the first one, and it's number one on our list, was compensation for capital loss only.
Right.
We certainly agree with AFCA's determinations. It's set on legal precedent. People may not like the but-for, but there's a good legal grounding for that to apply. But as a scheme of last resort, we also recognise we have limitations as to what we can pay in compensation. $150,000 is an example of that. We think that there should be a recommendation that we're paying compensation up to $150,000 for capital loss only. So that's the first one. And I'll just reiterate, we support AFCA's approach. It is the right approach.
Especially if it's coming from a firm that is still in business and it's not going to the scheme of last resort, having the but-for there. I know there are some that still disagree with the existence of the but-for in those instances as well. But the idea is, you're putting the client where they would have been had the advice not been had they received good financial advice, not some level of misconduct.
Return them to the position they should have been.
Yeah. Right.
The next is just the limitations surrounding PI insurance and the inadequacy of the coverage. This one, it gets a lot of headlines. It's a slow burn. Making changes here, this is not the panacea that everybody would expect that, aren't I already paying insurance through PI? What do I need the compensation scheme for? There's a few things with PI insurance which we see as difficult limitations. So the first is PI cover doesn't cover us. It doesn't cover customers. It doesn't cover creditors. It covers the organisation.
Right.
So if there's to be a claim and the firm's insolvent or in administration or liquidation, what incentive is there for a liquidator to pay in excess for a professional indemnity claim when they know most professional indemnity lawyers are going to fight tooth and nail not to pay? There's just very little incentive. Now, there are other issues with PI cover, and we've shared these with ASIC. I don't think there's any surprises with these. Your listeners would relate to them. Some of them are that the PI cover is not going to be sufficient to cover the loss. We saw that with Dixon.
Yeah.
The policy may not cover the specific conduct, so not all PI covers would be able to be drawn on. There's little or no appetite for firms to access their PI even when they're solvent. The inconsistency of policies, and it's recognising that a lot of the self-licensees and even the larger licensees, they're not in a position of bargaining power. They take what they can get. So it's the insurance companies that are in control of what the PI cover will cover and when they'll pay. We're also concerned that if we start drawing on PI insurance, what happens to PI insurance premiums? So there's a detrimental impact that happens with that. There's also some PI cover won't cover the claim when it's lodged because it relates to conduct that's previous, and we have no ability to access the PI.
Right.
So we would like the access to do that. At the moment, the best we can do is ask for, is it there and would there be a claim that could be made by the liquidator? But that's just information gathering powers. It's not actually instructing the liquidator or administrator to do anything.
Right.
So that's, when it comes to the PI insurance, we have also advocated that a possibility of a cap for major and massive firm failures. So instead of having 150,000, we think that we think the 150,000 is reasonable, but we also think that the minister should have some level of discretion where there are large failures with multi-millions, tens of millions, hundreds of millions of dollars worth of losses, that the minister has some level of discretion to reduce that cap.
Right.
Now, whether Parliament would approve that, I don't think that they would, but I think having those sorts of powers does make dealing with significantly large firm failures a little easier.
Right. So that the idea essentially would be making it, ensuring that the scheme is sustainable in that instance by reducing the amount that can be awarded for each claim, essentially.
Yes, yeah,
Right.
or for a class of claim.
A class of claim, yeah.
Yep. The other change that we would recommend is just getting greater clarity. At the moment, the compensation is capped at a per person level, not a determination level.
Right, okay.
And what that means is, depending on how the determination is worded, it can mean that one beneficiary could get multiple payments up to 150, depending on how that determination is worded.
Right. So what's an example of how that might happen?
So determination awards, Mr. $50,000, Mrs. $5,000, and their self-managed super fund $150,000. Well, there's 3 different people there.
Right.
So that 150,000 cap is for each of those entities. We're suggesting that be limited. In the first case, we would suggest that it's 150,000 per beneficial person.
Right.
But we've also put up the suggestion there, it's just capped at 150,000 per determination.
Right. So,
and that's about 6% of all claims have more than 150,000 being paid.
They end up having more than that 150 actually being paid.
Yes. So
right.
About 6% of all determinations will be paying more than 150. Now, sometimes it's only marginally more, but it's above that 150 expectation.
So that would be in an instance where the individual and their SMSF, for instance, both get some level of compensation.
Yes.
Right. Well, that's
yeah.
Okay.
So
that's not really a cap there, is it?
No.
If you can go over it.
We've talked about deductions made to the compensation payments, so coming off the bottom as opposed to the top, and just increasing the breadth of our subrogation powers so that we can go harder against firms.
Right. Okay. So that's kind of encapsulates broadly what the CSLR has put forward.
Yes. Yeah. Look, there's a number of other things under the other under some of our other observations, but that pretty much covers most of it. I think anything that will help support the victims and make sure that the scheme is sustainable, we're quite open to talk through, debate and challenge. We recognise this sits with the Minister and he'll have many competing ideas and methodologies to listen to. I know there's certainly arguments, should product be included? We're agnostic on that. I think the hard part with that is, that's a fun job for AFCA to try and work out, well, how much should be apportioned to the product and how much should be to the advisor. If the Minister was to make the change, we'd support it. I think there's greater scope, though, in the inclusion of product in the special levy as opposed to the eligibility criteria for the scheme.
Right. I guess because it's already open to be included through the special levy as the legislation stands, so it's easier to kind of roll it in there versus actually changing the legislation to include like managed investment scheme providers, for instance.
Yes. Yep.
Yeah. So on the idea of the splitting responsibility, or how they determine the how much would go to product, how much would go to the advice, how much would go to, the super fund trustee, for instance, if it were, if they added them into the CSLR as well, which I don't think anyone's really called for that. It hasn't really been an issue until First Guardian and Shield. But there are some for instance, like UGC determinations that do also have next gen advice as a kind of as financial firm 1, financial firm 2. That there's a few of those, and they've got a split of 30% of the compensation to next gen, or to financial firm 1, 70% to financial firm 2, or they only have to pay $5,000. This one has the other 380 something. That's something they do there. Does feel like it might be a bit tougher to apportion based on product versus advice there, though, right? It feels like it'd be tougher.
And it is. And you've got to ask, this is one for Charles. I don't think he's got the power to actually do much in the way of product. So, asking him to do something he has no power to do, like he needs the legal power to do it.
The complaint would have to be against both of them, right?
It's a question for Charles. He'll tell me off, David, why did you even mention my name? But he's the ombudsman.
Actually, he is coming on the podcast, so this is good. Kind of just a final question, I think, because kept it for a while already. We could go a lot longer. Looking at some of the other submissions that have been made to the review and potentially, the special levy, which not like they're available yet. We've once again, when we're recording, we're a day before the submissions close. So maybe we'll see some tomorrow or, 5 days ago if you're watching now. Any submissions that have there's recommendations that have really jumped out and been like, yeah, that one makes a lot of sense, or anything along those lines?
No, look, I have to say Treasury did a really good job with this consultation paper. It's very comprehensive. So for any advisors that are wanting to read it, if you can read a statement of advice, you've got time to read this. It's probably about the same length. It articulates that the minister has certain legislative powers and they're really limited. So how he deals with this special levy right now, it's all really clearly outlined what it would mean and with each of those options. If you go to the appendix, you can have a look at it. I think
got it right here, actually.
Yeah,
got the appendix here and everything. So it is quite detailed.
Yeah. So for those advisors who think they're going to be they're paying the bill for the extra $47 million for the special levy, read this, because it'll make it clear that yes, that might be one of the options, but there are other options on the table that are probably more likely to be considered.
Yeah, it's hard to really make a prediction on what is going to happen. Obviously, you've got to wait until you see what all of the submissions from all the interested parties are, what Treasury puts forward, how the minister reacts to them, which ones are particularly convincing for him. But as you mentioned, there's a lot of options. I went through a lot of them on a previous podcast with Phil Anderson from the FAAA. I went through a lot of the options there of what he could do and everything along those lines. I think where Phil kind of landed was approaching it based on capacity to pay was where the FAAA's kind of landed with theirs. Obviously, we might get more detail once their submission's available, of course. But broadly speaking, do you feel that there's I guess there's a lot of options for him. Is there any that kind of jump out to you as that maybe that's the best approach, or you don't really have an opinion on that at this stage?
We really don't have an opinion on this. Our challenge is, we know that without the special levy funds, come November this year, we will stop making compensation payments for anything other than the pre-CSLR, which is predominantly all Dixon, the first tranche of Dixon.
Yeah.
So until those special levy funds come through, we're going to be paying a limited amount of compensation. That said, once the minister makes the decision, that's still got to go through Parliament for approval. And that's 15 disallowance days that it's going to take some time. There's a number of sitting days, and then ASIC, once it passes, assuming there is no motion to disallow, ASIC will need to issue the levies, collect the money, and get it to us. I think it's unlikely that we're going to receive these special levy funds before 1st of July next year. And that's part of the challenge we've got with our process, where we're working now on the FY27 levy estimate.
Yeah.
Come October, we'll announce what we think is required, and that will start going through the parliamentary process in October. We're having to do that and try and forecast out through to June 2028, to try and work out, well, how much do we think we'll need? Now, the biggest contributor to this at the moment, aside from the firms, or the size of the levy, is just the speed with which AFCA is able to get through the work.
Yeah,
this is not something we want them to rush. It's complex. We want to make sure they're doing the best job they possibly can, and it's going to take them some time. It's pretty skilled work that they have to go through, assessing all the information. So it's going to take them a long time to get through Dixon, UGC, Bright, the fallout from Shield and First Guardian, let alone all of the other smaller firms which are continuing to filter through. So we would expect that there's going to be substantial levies for the next few years.
So when in November, sometime in November, that's a run out of funds kind of point, is it?
Yes.
Right. If we go past, because consultation ends on the 29th of August, there is a sitting week directly after that. There's then only 15 sitting days after that for the rest of the year for Parliament. is it 15? It's 15 sitting days, correct?
15
for the
sitting days.
disallowance. So, I mean, that it would, unless he makes a decision like a couple of days after the submissions close and puts it in the September sitting week, the disallowance motion period wouldn't even be finished until after, sometime after the end of the year.
Yeah.
So,
It's more likely to be February, March.
So almost guaranteed that CSLR stops being able to pay compensation entirely.
We'll continue to do work. It's not like we'll be sitting twiddling our thumbs. We'll still...
It's just the actual payment part, right?
We'll get it all ready up to be the ability to offer, make the offers to claimants, but it'll just sit there until the funds come through. Now, look, that's something we're going to have to navigate. That's the legislative process. There's no shortcuts here. We need to go through this. There needs to be a level of due process. So I'm not saying this from a woe is us point of view. It's just that there are impacts. Now, it gets even messier where, at the moment, ASIC has just issued the FY26 levy.
Right.
It should be in boxes this week if it's not already there. So we've got the FY26. The FY27 levy will be coming out probably in March. We've also got the special levy for FY26, which is somewhere in that period. And then we're doing a revised estimate for the FY27 in May, June next year. So there's a lot of levies in this and trying to manage all of this. The timing of when those funds come through is not a nice and simple, okay, we're going to get this much on this day and this much on this day. If the special levy comes through for FY27 in FY28, we have to work out, well, who are the eligible claims in FY27 that we're now paying in FY28?
Right.
It gets a little bit messy. We're working through it, and we're certainly encouraging the Minister's office to please make a decision. But that's at his discretion, and we'll support whatever decision he comes out with. We just know that there are a lot of people that from November this year will be waiting.
Yeah, no, they will. The operation costs for the CSLR are also paid through the levy, correct?
Yep.
I mean, you guys are going to be working for free after November. Like, you're going to be on back pay. Like, do the people who work for the CSLR, does it halt them being able to be paid?
No, because remember there are 4 subsectors, and this is just one of those subsectors.
Right.
The operating costs of the scheme are shared equally, pretty equally across all 4 subsectors, regardless of how many claims they might have. We feel they get the benefit of the scheme. They may not see it as benefit, but we do. It benefits their industry. That's why we then share that equally across all 4 subsectors.
Right. Okay. So at least still able to get paid. You're not doing your job for free. That's certainly good for on that end. I think that's probably. I mean, I've probably got another couple of hours in me of going over this stuff with you, but we might have to wrap it up there, unfortunately. Just as like a final sign off, if there was just one change for the CSLR that you would look for, just right at the top of the list, like probably mentioned it already, but what would be that top priority, I guess?
The top priority, look, it's that wish list that is not likely to come is a shorter disallowance period.
Okay, right.
It just means that I can make forecasts that are more accurate, closer to the date that they're due, and we can be more responsive. When you're having to predict things so far out, it's just a real challenge.
Yep. No, fair enough. I mean, another option, people, stop doing the wrong thing. Also a good option.
Yes.
Not sure.
Sorry, can I restate what my first? Yeah.
Not sure we've got too much scope to kind of mandate that. It's already kind of.
Look, can I say, look, there would be a lot of people who think that we're out for the financial advice sector. We're not. I've mentioned a number of times in a number of different forums.
Yeah.
We need more. We need more people who are...
Just to spread the cost of the levy.
Well, I think there's more demand for people who need this advice.
Yeah.
And I think as a profession, there is a need for more people giving the right advice that are motivated by doing the right thing. That's not going to change anytime soon. We're going to need more and more people, and if there's less and less in the industry, or if there's damage to the industry where people are not incentivized to go to this, they're going to start making their own decisions.
Yeah.
Or they're going to turn to Chat GPT, tell me what I should do. And that might work, but I've got a lot more faith in talking to someone who has really good experience. And my personal advisor, I trust him. He's a critical part of my investment decisions.
And I don't think OpenAI is a member of AFCA, so might not have much course.
It doesn't have a license
there.
either, so
No. So probably not much recourse there if you get poor financial advice from a AI chatbot. So anything we can do to avoid that is probably good.
Yeah. And look, we abide by the legislation that's set. We have no discretion. We do exactly as the legislation outlines.
Yeah.
The only thing we can do is be transparent, and that commitment holds now. It will continue to hold. If people have questions, come to us and we'll ask. We'll answer them. But we're quite happy to share our thinking where we can.
Awesome. Well, thank you very much for coming on the show, David. And hopefully we get some clarity, maybe even before this episode comes out. I don't think so, but hopefully.
Yeah, well, we can hope, but hope's not a strategy, so we'll continue to work hard in the meantime. But thanks, Keith. We really appreciate the opportunity.
Awesome. Thank you again, and thank you to everyone for listening along or watching, if so. Appreciate you taking the time, and hopefully you learnt a little bit about what's going on in the CSLR from David Berry. So thank you again, and bye for now.